January 2008, 1 US dollar bought 1.17 Turkish lira. June 2026, that same dollar buys 46.29 lira. In 18 years, the Turkish lira has lost approximately 97.4% of its value against the dollar. A currency doesn't just collapse like that by accident. It is dismantled, piece by piece, decision by decision. And the story of how it happened is not just a story about Turkey. It is a warning about what happens when a country decides that mathematics does not apply to it. Welcome to Mr. Finance, where money, power, and history collide, and nothing is ever as simple as it looks. To understand how the lira went from 1.17 to the dollar to 46 to the dollar, we have to go back to where this story really begins. Not 2008, not even 2000, but 1923, when the Republic of Turkey was born out of the ashes of the Ottoman Empire. The Ottoman lira had been debased for centuries, a currency that had once been one of the world's great monetary standards, reduced to near worthlessness by war, inflation, and the steady erosion of imperial power. The new republic inherited that broken monetary legacy. It printed money to fund everything from industrialization to war efforts, and by the end of the 20th century, the lira had become a punchline. In 2001, at the height of Turkey's worst modern financial crisis, the lira hit 1.65 million to the dollar. 1.65 million. That is not a typo. The currency was so debased that in 2005, Turkey simply cut 6 zeros off the lira and called it the new Turkish lira. 1 new lira equaled 1 million old lira. It was a cosmetic fix. The underlying disease remained. Now let's talk about what that disease actually is. Here's the mechanism. A currency is worth what people believe it is worth. That belief is built on 3 things. First, price stability, the confidence that your money today will buy roughly the same basket of goods tomorrow. Second, institutional credibility, the belief that the central bank will act independently to protect the currency's value. Third, external balance. The country must earn enough foreign currency through exports or investment to pay for its imports and service its debts. When all 3 hold, a currency can be stable for decades. When all 3 break, a currency enters what economists call a depreciation spiral, and that spiral is almost impossible to stop. Between 2008 and 2018, Turkey broke all 3. Let's walk through it chronologically. In 2008, the lira was at its strongest point in modern history. Turkey had just come through a decade of IMF-backed reforms. Inflation had been brought down from astronomical levels. The economy was growing. Foreign investors were pouring money in. But underneath that surface, the old habits were still there. Turkey ran a persistent current account deficit. It imported more than it exported year after year. To fund that deficit, it borrowed heavily in foreign currencies. By 2018, Turkey's external debt had reached 466.7 billion, roughly 55% of GDP. That is like a household that keeps spending more than it earns. It covers the difference with credit cards in a foreign currency. As long as the foreign currency stays cheap, it works. The moment it gets expensive, the whole thing unravels. The unraveling began in earnest in 2018. On August 10th, President Trump announced that the U.S. would double tariffs on Turkish steel and aluminum, to 50% on steel and 20% on aluminum. The trigger was a diplomatic dispute over an American pastor detained in Turkey. But the damage went far beyond tariffs. The announcement sent a signal to global markets. Turkey was politically unstable, and its currency was risky. The lira plunged 18% in a single day. By the end of 2018, it had lost more than 30% of its value against the dollar. The panic spread beyond Turkey's borders. The Russian ruble, the South African rand, the Brazilian real all fell in sympathy. Emerging markets around the world caught the contagion. Turkey had become a warning to every country that borrowed in dollars. Here is where the story takes its most tragic turn. In June 2018, Recep Tayyip Erdogan was re-elected president with expanded powers. He had long described himself as an enemy of interest rates. His belief, stated publicly many times, was that high interest rates cause inflation, the opposite of what every mainstream economist teaches. And now he had the power to act on that belief. Over the next 3 years, he fired 3 central bank governors. Each time a governor raised interest rates to defend the lira, they were replaced. Each time they were replaced, the lira crashed. On March 22, 2021, Erdogan fired Governor Naci Ağbal in the middle of the night. Ağbal had raised rates by 875 basis points during his tenure, and the lira had actually stabilized. The morning after his firing, the lira fell 16% in 10 minutes. 10 minutes. All that work, undone in the time it takes to make a cup of coffee. The failed fix came in December 2021. By then, the lira had lost more than 50% in less than 100 days. The stock market had triggered trading halts 3 days in a row. Erdogan announced a radical new policy. The government would guarantee lira deposits against depreciation. If the lira fell against the dollar, The government would compensate savers for their losses. It was called the KKM program, the Foreign Exchange Protected Deposit Scheme. The announcement sent the lira soaring 30% in 3 hours, the biggest single-day rally in its history. Investors thought, finally, a backstop. But here's the problem with guarantees. The government cannot guarantee the value of its own currency unless it has the foreign reserves to back that guarantee. Turkey did not. The KKM program cost an estimated $60 billion over its lifespan. It did not stop the lira's decline. It only delayed it. By early 2026, the program was quietly terminated. Another failed fix, another bill that someone eventually had to pay. The breaking point came quietly, not with a bang. In February 2025, the lira crossed 36 to the dollar for the first time. By June 2026, it had reached 46.29. Turkey's inflation had peaked above 80% just a few years earlier. Today, it remains above 30%. The central bank raised interest rates to 50%, then held them at 37%. It did not work. The currency kept falling. In mid-2026, Turkey sold roughly 90% of its U.S. Treasury holdings, from $160 billion to about $18 billion, just to raise dollars to defend the lira. It was like a person selling their furniture to pay their credit card bill. It buys time. It does not solve the problem. Now let's connect this to the rest of the world, because Turkey is not alone. In Argentina, the peso has lost more than 90% of its value against the dollar since 2018, with inflation exceeding 100% in 2023. The pattern is identical: fiscal deficits, central bank independence eroded, and a currency that becomes a vehicle for speculation rather than a store of value. In Zimbabwe, hyperinflation in 2008 reached 79.6 billion%, a number so absurd it sounds like a typo. The government printed money to pay its bills, and the currency became worthless. In Lebanon, the lira, their pound, lost more than 98% of its value between 2019 and 2024, as the central bank burned through reserves trying to defend an overvalued exchange rate. In Sri Lanka, in 2022, the rupee collapsed, the government defaulted on its debt, and the president fled the country. These are not isolated events. They are the same story, playing out in different countries at different speeds with different costumes. The script is always the same. A government spends beyond its means, borrows in foreign currency, prints money to cover the gap, and then wonders why nobody wants to hold its money anymore. So, what is the bigger mechanism here? Here is the aha moment. Fiat currency, money that is not backed by gold or silver, is ultimately backed by one thing only: trust. Trust that the government will manage the money supply responsibly. Trust that the central bank will act independently to fight inflation. Trust that your savings today will be worth something tomorrow. When that trust breaks, the currency breaks. And here is the cruel math of currency depreciation. When a currency loses half its value, the price of imported goods doubles. When the price of imported goods doubles, inflation accelerates. When inflation accelerates, the central bank is forced to raise interest rates. When interest rates rise, borrowing becomes more expensive and economic growth slows. When economic growth slows, tax revenues fall, the deficit widens, and the government prints more money, which makes the currency fall further. It is a loop, a death spiral. And once you are in it, getting out requires pain. Deep, prolonged, politically painful austerity that no elected leader wants to impose. Think of it this way. A currency is like the oxygen in a country's economic bloodstream. When it is stable, oxygen flows freely. Businesses invest, people save, trade happens. When it collapses, it is like the oxygen is slowly being replaced with something else. The blood still moves, but it cannot sustain life. A country can survive a currency collapse, but the scars last for generations. In Turkey today, a worker earning 30,000 lira a month, which sounds like a decent salary, is actually earning about $650. In 2008, that same salary in lira terms would have bought $25,000 worth of goods. The purchasing power of that worker's labor has been cut by 97%. That is not just an economic statistic. That is a life, that is rent, that is groceries, that is school fees, that is the future, erased. And here is the deepest lesson of the Turkish lira's collapse. A currency is not just a number on a screen. It is a social contract. It is the promise that if you work hard today, you will be able to buy food tomorrow. It is the promise that if you save for retirement, your savings will still be there when you need them. When a government breaks that promise, it is not just breaking an economic rule. It is breaking faith with its own people. And faith, once broken, is almost impossible to restore. What can we take away from this? 3 lessons. 1. Central bank independence is not a luxury. It is a necessity. When political leaders control the money supply, they will always choose short-term popularity over long-term stability. Every country that has suffered hyperinflation or currency collapse has done so after the central bank lost its independence. 2. Foreign currency debt is a trap. Borrowing in someone else's currency means you are at the mercy of someone else's monetary policy. When the dollar strengthens, your debt grows. When your currency weakens, your debt grows even more. It is a double bind. And 3, inflation is not just a number, it is a tax on the poor. The rich can protect themselves. They buy gold, they buy dollars, they buy real estate. The poor cannot. They hold lira, they hold cash. They wake up one morning and discover that everything they saved is worth half of what it was yesterday. And there is no compensation for that loss. The Turkish lira went from 1.17 to the dollar to 46 to the dollar. That is not a market correction. That is not a natural fluctuation. That is a system broken by design. And the question every viewer should ask themselves is not what happened in Turkey. The question is, could it happen here? Because history suggests if the conditions are right, if the institutions are weakened, if the leadership decides that the rules of economics do not apply, it can happen anywhere. If this gave you a new perspective, hit subscribe. History has the answers.